Welcome back, everyone, to our ongoing explainer on the CECL model ASC 326. Now, if you are with us for the first section, you'll remember we talked about the absolute seismic shift in accounting that happened after the 2008 financial crisis. We fundamentally moved away from the old incurred losses model, where we basically sat around waiting for things to go wrong before recognizing a loss, and we transitioned into this completely new world of lifetime expected losses. Well, today, we're taking that concept and putting it into immediate practical action. We're going to look really closely at the strict rules of scope, meaning exactly what financial instruments does this standard actually apply to, and when do you have to record those losses? To do that, we've got a quick roadmap. We'll define the scope, look at what gets excluded, tackle the big day-1 recognition rule, and wrap up with how we actually manage the credit loss allowance. Let's get right into it. Okay, kicking things off with Section 1, defining the CCL scope. Or, in other words, what exactly gets caught in the CCL net? The fundamental threshold concept that you really need to burn into your memory here is amortized cost. CECL applies to financial assets that are measured at amortized cost. So what does that actually mean in plain English? It means these are assets where your company expects to collect cash over time, and you're carrying that asset on your balance sheet at its original cost, just adjusted for any payments you've already collected. It's that simple. If an asset is measured this way, CECL applies. Period. It literally does not matter how small the asset is, it doesn't matter how old it is, and it doesn't even matter how incredibly low you think the expected loss might be. If it's held at amortized cost, you are in scope. Let's ground this in the real world. I want you to mentally check these main categories against your own company's balance sheet. Do you have trade receivables? Because that includes your everyday customer invoices, subscription billings, or professional service invoices. Do you have loans receivable, like bank loans or intercompany loans? What about notes receivable, like a promissory note or an employee loan? Then we've got held to maturity, or HTM, debt securities, think corporate or government bonds. And finally, your net investment in finance leases, like equipment finance lease receivables. I can absolutely assure you, if any of these items are sitting on your balance sheet right now, they are definitively in scope for CCL. There's just no escaping the net for these asset types. But here is where CECL gets even more expansive. It actually reaches right past your balance sheet. The standard also applies to specific off-balance sheet credit exposures. We're talking about things like unfunded loan commitments, so the committed but undrawn portions of your credit facilities. We're talking about financial guarantees, where you guarantee another party's payment obligations. And we're talking about letters of credit. Now, there is one absolutely crucial caveat here. These items are only in scope provided they are not unconditionally cancelable by the issuer. If you have the power to pull the plug on the commitment at any time for any reason, you're out of scope. But if you are firmly committed, it is officially caught in the CECL net. Now, what's really fascinating here is the cause and effect of whether an item is on or off the balance sheet. For your standard on-balance sheet assets, your expected loss is recognized as a contra-asset allowance. It just sits there, reducing the value of your asset. Simple enough. But think about those off-balance sheet items we just talked about. They aren't on your balance sheet yet. You obviously can't reduce an asset that doesn't exist. So the direct consequence is that the expected loss for off-balance sheet exposures must be recorded as a liability. It's a really vital mechanical difference that you need to keep straight. Moving right along to Section 2, assets excluded from CCL. Let's see what actually passes right through the sieve. You can take a breath here because not everything has changed. Several major asset types are explicitly excluded from the CCL model, simply because they're already governed by perfectly good existing accounting models. For instance, available for sale, or AFS debt securities, those fall under ASC 326.30 because they're assessed individually and their non-credit fair value changes go straight to other comprehensive income. Equity securities are handled by ASC 321 because they're already carried at fair value. Loans at fair value option belong to ASC 825 because their fair value already reflects credit risk. And operating lease receivables, which remember are completely different from the finance leases we mentioned earlier, well, those fall under ASC 842's lease impairment guidance. So if you're dealing with these assets, you can safely set the CCL handbook aside. That brings us to Section 3, the Day-1 recognition rule. This is, without a doubt, CCL's most important practical rule. All right, we've established our scope. We know exactly what assets we're looking at. Now we arrive at the absolute climax of this explainer and a complete paradigm shift. When an asset is in scope and it is first recorded on your books, when do you recognize the allowance for expected credit losses? Immediately. I want to pause there for a second because the standard means exactly what it says. There are zero exceptions here. There is no grace period. There is no let's wait and see if they pay a little late period. There's no minimum threshold where you can say, well, it's just a tiny invoice, we'll ignore it. The very moment that asset hits your books, you must immediately estimate and record its lifetime expected credit loss. And this brilliantly illustrates exactly how dramatic that shift is in real life. Let's look at 3 common scenarios side by side: the old incurred loss model versus our new CCL reality. Event 1. You raise a new customer invoice. Under the old model, you booked no allowance unless you had specific evidence of a collection problem. Under CCL, you immediately record an expected loss based on historical rates and forward-looking factors. Event 2. You originate a brand new loan to a borrower with flawless credit. Old model, no allowance on day 1, we just assume they're current. CCL, you immediately record a lifetime expected credit loss. Yes, even for the borrower with perfect credit, because mathematically, over the life of an entire portfolio, some losses are just expected. Finally, a note receivable from a related party. Old model, no allowance unless there's doubt. CCL, immediate estimation and recording of expected loss, even for low-risk related parties. You no longer wait for a trigger event. You anticipate. And finally, Section 4, managing the credit loss allowance, where we'll look at the actual mechanism of the balance sheet reserve. Now that we've fully absorbed the reality of immediate recognition, let's look at the actual mechanics of how this gets recorded. This introduces the ACL, the allowance for credit losses. This is your balance sheet reserve. It holds the cumulative estimate of expected losses across all of your in-scope financial assets. As we mentioned earlier, for on-balance sheet items, this acts as a contra-asset. It sits right there on the balance sheet and reduces the gross receivable or loan balance. This is what gives the users of your financial statements the true net carrying amount, which is the amount of cash you actually expect to collect at the end of the day. So the crucial takeaway here is that this allowance is definitely not a set it and forget it number. It is highly dynamic. Every single reporting period, and I mean every reporting date, not just at year end, you have to recalculate the required allowance. If the new required allowance is higher than your current balance, maybe because credit quality deteriorated or your portfolio simply grew in size, you record a credit loss expense to bump it up. Conversely, if the required allowance is lower than your current balance, because maybe credit improved or your portfolio shrunk, you record a credit loss benefit to bring it down. It is a constantly moving target that reflects the real-time reality of your portfolio. Which leaves us with a pretty massive cliffhanger. If this allowance is never optional and it is never static, how exactly do we calculate these lifetime losses every single reporting period without losing our minds? What is the actual structural process for generating that number? Well, that is exactly what we are going to unpack in our next explainer, where we dive into the 7-step CCL framework and the concept of pooling. Think on that, go review your balance sheets, and I'll see you next time.